Hello everyone, and I trust you had a nice break over the weekend, and here we are for another exciting week of financial markets, economics and trading, price action, etc. Obviously it was a very interesting day in New York on Friday, but we did see retail sales collapse a whopping 1%. Not a good outcome at all, and suggesting a new trend is in place for retail sales in the United States, one of weakness, following that momentary post-holiday season spike that we saw in a lot of data in the US. And I said at the time that's probably what it was, a momentary spike before the economy subdued for the rest of the year. And that's certainly how the data continues to look. We also saw consumer confidence. It was up small on the month, but it's still down from a couple of months ago. And it's still deep in GFC style recession areas, so territory. So not a good number at all. I mean, it's all very well to sort of get excited about 1 month's data, but the run of data is pointing to continued upward price pressures and to a weakening US economy. And we saw that in the upward price pressures last week, where both the core CPI ticked back to the upside and inflation expectations were very strong. So it was all very well to sort of focus on the headline, simplistic, shallow news that, the headline inflation number had declined, but the Federal Reserve would indeed been alarmed at the resurgence in the core CPI. The stickiness has become the new buzzword for that look of inflation. And it would have also been concerned by inflation expectations moving higher as well. The Fed has said on frequent occasions that one of the reasons it's raising interest rates is to make sure that expectations about inflation remain anchored. So that number will have been of significant concern. We saw some slightly better than expected factory industrial data on Friday, but really that's just a consolidation, if you like, of a weakening trend that had been in place for a while, so nothing to be too excited about. And we continue to see around the world those kind of flattish growth outcomes. The spike in China's exports last week, by the way, was largely due to an increase of 150% of exports to Russia, and otherwise was not the fantastic number that many thought it would be. So the stage is set this week. Post some initial, usually Mondays are a buying period for the US stocks, S&P 500 for instance, and that tends to influence a whole host of other markets. But we're not quite seeing that in Asia as yet today. Usually on a Monday you would see Asia price action being firmed, then European price action, then US trading session price action. The fact that Asia isn't quite ticking up yet might be that I'm just not being patient enough to see it, but I do think the run of data overall last week points to continued firm inflation, which points to continued Fed hikes, not the market sentiment view, the consensus view, but mine. And you'll know that we've been well ahead of the market for the last 18 months in forecasting inflation, and we forecast the Federal Reserve rate hikes probably better than anyone else on the planet, say I. But yes, I'm still seeing further rate hikes. I'm still seeing continued upward pressure on inflation, given that US energy prices are beginning to again rise there, both natural gas prices stabilizing, showing signs of moving higher, and gasoline prices are already considerably higher than the lows that we're seeing there. And none of that was in last month's inflation data. So next month's inflation data is going to be a lot firmer, even if gasoline prices stay where they currently are. So keep an eye on those US gasoline prices. If they move higher, inflation in the US will again be taking off to the upside, which will do nothing for the Federal Reserve rate trajectory outlook, which will do nothing for that sentiment that is mistakenly built around the idea that if the Fed stops raising rates, stocks will go up. this mistaken belief that bad data is good for the market, I think that idea has just about run its course. And we're at a period now where gradually it's starting to sink in, which is something we've all known all along, that bad economic data is actually not good for stock valuations because it means lower earnings and lower valuations, of course, going forward. So I think we are kind of at the end of that false euphoria hope that in any case the Federal Reserve won't be cutting rates, but that idea that bad economic data would force the Fed to slow, would force the Fed to pivot, never going to happen, still isn't, and therefore it was a time to buy stocks. That whole way of thinking is a total nonsense, but we had to respect it for a period of time as it dominated market sentiment and trading. And, there's a whole lot of fund managers out there who have a very much a head in the sand approach to investing. In other words, the superannuation payments come in every month and they just buy a host of stocks and bonds and keep their head in the sand and don't worry about what's going on in the world. That process is also nearing completion, I think. So whilst we saw marginal new stock price highs in the US on Friday, I do think the market was looking tired going into the close, and there could be a risk week ahead here for US equities. If they again break Friday's New York high, you'd have to respect that in price action terms. But otherwise, I still think it is an economic outlook, a fundamental outlook of a slowing, struggling US economy with great political paralysis at play in the background, with the risk of default, which I don't think will happen, but it is definitely a possibility because the Republicans may just want to make a point, but probably they won't do it because they do want to win the US elections that are coming up, the presidential elections, and that does look positive for the Republicans at this point in time. So, by the way, Trump's popularity has shot upwards post his indictment. So I don't think that indictment is going to work the way the Democrats had hoped to retard the former president from running again. And the probability is that Trump will be re-elected. I mean, I forecast he'd win the first time. I then forecast Biden would win. I've been forecasting now for some time that Trump will win again. I also forecast Morrison to win the Australian election that no one thought he could, and then I forecast Albanese to win. I do think Trump, so I'm trying to get, how many is that? I've got five right in a row. So going again, at some point, obviously I have to be wrong, but I do think Trump will win the next presidential election in the United States quite significantly. So given that, the Republicans probably will not force a credit default, but they will make it scary so that the public is aware that things are not right in the management of the US economy from their point of view. So that will be the play there. So that is something that will also weigh on markets at some point. The idea that, oh, what if the Republicans do force the default, because they will push it to the line. But I don't think that will happen. Nevertheless, it's a very clear statement about the state of the US economy as property prices continue to fall, equity markets languish, bond prices remain vulnerable to the downside, and the Fed is likely to be hiking more on last week's inflation data. That's the more likely outcome of the inflation data last week than the market's preferred view that it means the Fed will stop. The Fed's going to hike this next meeting, and then the discussion will be about what's the next inflation number going to be, and that's likely to continue to see strong core CPI and to be impacted by higher gasoline prices in the US, which all points to inflation numbers over the next 1 to 2 months that will not be favorable to the view that the Fed will be stopping hiking interest rates. So perhaps another 2-3 Fed hikes to come, not the one that the market is hoping for. I hope that's been of some help. Clifford Bennett, Chief Economist, ACY Securities. Do have a good week's trading. Thank you very much.